The last of the 6 requirements are the reinvestment targets. There's a couple different ways of thinking about this. But in general, first of all, you must use all of the cash proceeds from the sale in the next purchase. Now, when we say that, that's in order to defer all tax. We'll talk about partial exchanges a little bit later. But in order to defer all tax, you've got to use all of the cash in the next purchases. You can't touch the money. Anything you touch becomes taxable. The second half of that rule is that you must purchase property that's at least equal to or greater than the value of the property you sold. If you buy down, that's the same thing as taking out profit. So again, you can do it, and we'll talk about that, but you're going to pay tax on the difference. So if you want to defer all tax, you've got to use all the cash, you've got to purchase at least as much as you sell. So the ways of thinking about this, take a look at the bottom of your settlement statement. You've got the cash you got at the end, plus whatever mortgage was paid off. That's going to equal your reinvestment goal. Make sense? Now, you may be a left-brained or a right-brained or a different brain thinker. If you are, you can start at the top of the settlement statement and say that your reinvestment target is your net sales price of the property, which is the contract price minus whatever the costs of closing were, but before the mortgage is paid off. So you must purchase at least your net sales price, and then after the mortgage is paid off and cash is left, you must use all of that cash in the next purchase. Either way of thinking about it, you're going to arrive at the exact same numbers. The question always comes though, but Dave, I put $20,000 down on this property at the very beginning. I want to take that out. That's not taxable. Well, that's very true. But the IRS says that when you are doing a 1031 exchange, the first dollar you pull out is not your original capital. It's $1 of profit. And of course, you're going to say, it is too $1. It's the original capital. I put it in. I'm going to take it out. I want to go forward with the profit. The IRS says, well, that's just wonderful. But for the privilege of doing a 1031 exchange, you are leaving your original capital in. If you take anything out, it's profit. So it's an argument, and it makes perfect sense on both sides. In order to answer who wins, I simply ask you, who has a standing army and nuclear weapons? So let's take a review of the basics and make sure we've got these, and then we'll dive into some fun stuff. The first thing is that what kind of real estate is it that we're going to be using 1031 exchanges for? Investment. Secondly, how many days do you have from the date of the closing of your sale to identify your potential replacements? That's our 45. Again, from the date of the closing of your sale, you have 180 days to complete your transaction. Remember that animal that's going to do these transactions for you called the qualified intermediary. Next to last, we've got the titling requirements, right? Same taxpayer, old property and new property. And then, of course, your reinvestment targets, which say purchase at least as much as you sell, use all of the cash in the next purchase or purchases, and you've completed a 1031 exchange. Seems simple. The devil's in the details, isn't it?